Hey everybody, welcome to a quick video on technicals and gamma levels that I'm watching. Here's my new screen. Nice and big, so I'm going to show you some cool stuff over the next few weeks here. We're going to figure out how to draw on it, use all the great features. But for now, let's just look at the technicals. We've got this long-term S&P weekly chart that has been obviously doing very, very well of late. We've seen a very faithful bounce off that 20-week moving average repeatedly, except for that one dipsy doodle down on August 5th we saw in that Volmageddon event. Very big explosion in VIX as we sold off on that Japanese carry trade unwind. But again, starting to act well. We came back almost as quickly and then acting fairly well into election time. And of course, everyone knows the rest. We bounced very, very strongly after the election, pulled back a little bit, and then have done very well since. We're starting to see a little bit of a concern. This is a weekly chart, so keep in mind, we are now dipping below that 20-week moving average. So despite the fact that some days these days are feeling okay, the problem is there's a lot of damage on those charts, and we definitely need to pay attention to that as income traders, because staying out of trouble is just as important as finding good trades. I'm going to be teaching you that over the next few months. We can see on this daily chart for the S&P, lower highs, lower lows. That isn't great. We did bounce off of this demand zone in here yesterday, but as you can see today, we have this very uncertain candle, very wicky top to bottom. So still, this market is struggling to find direction again. So another a daily here, we can see this, if you draw some different lines on there as opposed to that downtrend channel, we can see these bottoms line up quite nicely. Yesterday, we started to push through there. We're back up above it. That's a positive, but again, that very uncertain candle that we've got today. MACD also still pointing straight down. I like to see that bottom moving average start to correct upwards, curl upwards towards that signal line. That's going to make me feel a little bit better that the downward momentum is starting to wane a little bit. So the QQQ, something similar. We have that downtrend channel. Didn't get quite down as far, but I'll show you in a moment. All is not well on the tech side of things, even though we've seen some real leadership in that area while the rest of the market hasn't done very well at all. I'll show you something about that soon. Here's your XLK, which is mostly made up of NVIDIA and Microsoft, at least 50%. And we can see that we broke out of this sort of channel through this support level, down through here very, very sharply, bounced back, uncertain candle, but we're still below this blue line here. That's why that's part of the reason why the market is having a little bit of trouble today, kind of hanging on, as well as some of the gamma issues that we're talking about here. So we can see, again, MACD, we need to see that recycle a little bit higher. Here is our XLF, so financials. You would expect financials to probably do okay into Trump and slightly higher rates. We don't want to see rates really, really take off, but I think there's a lot to be positive about in that area. We have some positions in names like Goldman Sachs. I think you're going to see a lot of deal making next year, more IPOs, a little bit more fun for that sector. But again, we certainly cannot say that this is a chart that looks phenomenal at this point. In fact, we've seen the 20-day cross through the 50-day. That is somewhat of a concern. What that means right now is this 9-day EMA starts to be resistant. So we'll see if we can get through here today. That's going to act as resistance. The 20-day is going to act as resistance. This is definitely lining up bearishly for now. This chart, again, a lot of work to do before looking really, really good again. Here we got the XLY, consumer discretionary. Really 38% made up of Amazon and Tesla. So those two really drive the truck on this particular fund, but coming down quite sharply. I feel like Tesla is probably going to make a run to 500. So I'm looking at a few different strategies there to take advantage of that. And then of course, Amazon, one of my favorites. We had 4 really, really great turbo trades last year. And I'm going to be doing more of those in my income product that will be available very, very soon to you folks. XLV, materials. So this is an area materials should do well in a strong economy. And by all estimates, economy is pretty darn good, at least in the US. We're seeing some problems elsewhere, which is probably part of the reason we've seen a big pullback, as well as rates having gone up. Rates are a really big deal these days. Since the Fed started lowering rates, we've seen the 10-year yield actually rise 100 basis points. So really a tale of two different kinds of rate environments versus expectation out there, and it's very confusing. So that's part of the problem for equities, as well as equities compete with fixed income yields. And now you're starting to get a little bit more juice out of those high interest savings accounts and fixed income in general. TLT, another slight negative today, I would say, on that tame PPI number. We are not seeing a very big bounce in the TLT. So clearly TLT has a little bit more work to do. It's right near those levels from late April of 2024. I think we could see a 5 to 5.10 yield on the 30-year, which would bring us probably down to around 82.5 on the TLT. So let's get under the hood a little bit more beyond the technicals. And this is really part of the reason that things are struggling. We've got this gamma picture. Now, we don't need to get into it too much, but the gamma picture basically is one where green is good. Green is good because it is supportive. It is something that reduces volatility because dealers have to they have the ability to buy on the way down. They have the ability to sell on the way up. They are able to be supportive of markets. Whereas when we get into a short gamma situation, that's where gamma flow can end up being an accelerant to the downside or upside occasionally, but in this case, it would be to the downside. So as I've been saying for a long time now, between 6,000 and 6,100, we have this gamma-rich area, which has dissipated a little bit at this point, but it was an area where the market was very supportive, and we saw other areas like CTA, vol-targeting funds being very supportive of markets. And I said, if we get below 59.75, this was around December 19th, if you recall my video, I said we could be in for a lot of trouble, and that's exactly what's happened. Below that 59.75 level on the S&P, I think we continue to have this negative gamma with little shoots of positive in here. However, negative gamma environment is going to continue to dictate some of the volatility that we're seeing out there. Now, we're going to play a little game of good news, bad news. I just gave you the bad news on the gamma side, but you can see that on the good news side of things, we're getting a lot of people selling puts into this sell-off. What that does is it replenishes dealer supply and starts to bring back some of that support that I talked about earlier that you get in a positive gamma environment. So less negative gamma, it doesn't necessarily mean positive gamma, but it means an improved situation from a volatility standpoint. Now, let's take a look at something else that's been very noticeable over the last 6 or 7 months, and that's been the VIX beta to the S&P, meaning the VIX, the fear gauge. How reactive has it been to sell-offs in the S&P? Well, we're still in the 98th percentile, very reactive. In fact, I like to call it the cat in the room full of rocking chairs. It's very nervous, looking around, fearful of pretty much everything. So the VIX has been very reactive. And we can see that on the dealer side of things, just as the gamma situation impacts dealers on index as well as individual names, it will impact them on the VIX. So they're basically short a lot of the upside calls in the VIX. So that is part of the reason they're not very welcoming of purchases of upside VIX calls. So they pull back and they make you pay for them because they're probably already in a situation where since August 5th, they do not really want to take on that upside VIX risk as much as they did the previous sort of 7-8 months in 2024. August 5th really changed a lot there. So we can see third percentile, meaning dealers really not on the right side of things from a VIX perspective. Now, good news, bad news? Well, here's the good news, is that exact thing, the beta of the VIX, the front VIX futures to the S&P has actually been improving. So we can see it was very reactive in August, and every subsequent sell-off has brought in a slightly less reactivity to the S&P sell-off. So I like to see that. You see this green line pointing down. This is from Nomura, fantastic source for volatility information. What I would not like to see is a push back up of reactivity into this area there. I think that would be really, really bad news. So another problem, bad news, good news, we're back to bad news, which is we're back into this world of really much of the contribution to the S&P coming from the Mag 7 and a couple of other names. Tesla, Amazon, AVG, Google, Walmart, these are all the names that have produced a lot of the positives since December, whereas the rest of the market has just been doing terribly. This is very reminiscent of sort of pre-August, before we started to get a little bit of broadening out in markets. That's what things look like. So I'm not very happy to see that. And the last thing we'll cover here is that from a positive standpoint, good news, bad news, from a positive standpoint, we can see that vol-controlled funds, now these are funds that allocate to the market as volatility comes down. Guess what they do when volatility rises? They start to sell. So they're in there with dealers selling, they're in there with CTAs. They are in a little bit of chase to the downside mode. They have now de-risked quite a bit. They were kind of all in December. They're back down to about a 40% percentile allocation. And that is actually very, very positive because they don't have as much to sell anymore. So we can see when they start to sell is when realized volatility starts to rise. That just means actual volatility, they have to sell. So we need this market to calm down, start to climb the wall of worry. And as soon as it does, we're going to see these vol funds get back into the market. And again, this points to that whole volatility clustering environment that we've really been in, and I believe we'll continue to be in, because it's just a fixture of the structure of markets these days. We're either in a low vol environment or a high vol environment. There's not a whole lot in between. So I hope you guys were a little bit informed by that video. We'll see you in the next one.